Greg Andrick here with another Business Freedom Conversation post. So hot off the press, Jerome Powell just made a statement, I believe it was before Congress, that the pause in interest rates is temporary, that they're going to increase them probably later in the year. Now, he stated that the Fed is trying to balance the policy between employment, monetary policy, inflation, and interest rates. So that's good that they're actually finally recognize it. He even mentioned in the video, and by the way, I have a video, it's about 1 minute and 20 seconds long, where you can see what he's saying, where he is saying that he knows they raised the rates 5 points in 1 year. That's astounding. Now, here's the problem. Here's why it affects you and as a business owner to look at this. 75% of Americans cannot afford a home at today's interest rates of around 7% on a 30-year mortgage. So if your business is related to things that deal with people's living space, their home, carpet, paint, furniture, there's a ton of stuff, it's probably the leading industry, construction, that leads to so many other things, because when people buy houses, either new or used, spend a lot of money on other things. If you're related to the auto industry, where people finance their cars, I believe it's something like 80% of car purchases are financed, you're going to see restrictions in your business, and you need to plan for that and know that it's happening. Now, we're in a really interesting situation because so many people, there was a story the other day saying literally everybody's got a low interest mortgage, which is probably true because everybody refinanced. And so the silver lining to this is that nobody wants to sell because they want to keep that 2 or 3% mortgage. That affects you as well in your business. So just take a look at this. The other problem that I think they're really wrestling with, why they're pausing it for now, trying to figure out what to do, is that banks hold $2.2 trillion in unrealized losses on their bond portfolios because the interest rates were raised so far so fast. It's a big problem. You're going to see more banks teetering, particularly if the economy slows and people need to withdraw the funds they've put in the bank. Powell did mention they're hoping the solution to Silicon Valley Bank and others failing was more regulation. More regulation has rarely solved any major problems. So I would be very circumspect that regulating banks more is going to resolve the issue that they're sitting on $2.2 trillion in losses because of how fast they raised interest rates. But it's part of the stagflation playbook. You got to know what you're dealing with and plan for it to survive. So take a look at what Jerome says, look at your business and see the components, look for the components that you can thrive and succeed on, and that you can counteract what's going to be coming down, because if they start raising interest rates again, say in the fall, and go up to 8 or 9, it's going to be a problem. And remember, these inflation numbers they're reporting, I'm really circumspect about the accuracy of that. So anyhow, Greg Andrick, Business Freedom Conversation. I'll catch you on the next one.
With inflation running well above our longer-run goal of 2% and with labor market conditions remaining tight, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5 percentage points since early last year and have continued to reduce our securities holdings at a brisk pace. Nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at last week's meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, we will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, inflation, and inflation, economic and financial developments. The U.S. banking system is sound and resilient. As detailed in the box on financial stability in the Monetary Policy Report, the Fed, together with the Treasury and the FDIC, took decisive action in March to protect the U.S. economy and to strengthen public confidence in our banking system. The recent bank failures, including that of Silicon Valley Bank, and the resulting bank stress have highlighted the importance of ensuring that we have the appropriate rules and supervisory practices for banks of this size. We are committed to addressing these vulnerabilities to make for a stronger and more resilient banking